Good afternoon, everyone. I am Aniket Kulkarni, Senior Partner at Pranitya Wealth. Today, we are in conversation with Mr. Praveen Bhadirao, Founder and Managing Partner at Pranitya Wealth. So, as investors, all of us have a lot of questions about the current global situation and how exactly it's going to impact the Indian markets. So, let's hear it from the veteran himself. First of all, before we go ahead towards the market outlook, I would like to congratulate Praveen sir on the launch of Pranitya India Opportunities Fund, a Category 3 AIF. Congratulations, sir.
Thank you.
Would love if you could brief us. We would love to hear about the Pranitya India Opportunities Fund and its launch at such a situation in the market. So, how do you foresee the fund?
So, idea of launching AF was there in mind, but ideally we thought we should spend enough time in the market like we started in 2020. So, after almost close to 6 years, after taking experience and managing money and all that, we thought it's the appropriate time to give client a different experience, and because we have third party products available, but not that all will fall in line with our ethos and our philosophy. So something can be carved out and completely customized for our set of clients was the idea behind this AIF. And we have appropriate now fund manager. We have a team of people in Bombay, and with our ideation maybe to a certain extent in terms of broad theme, this team will entirely work for us and our set of clients, and I'm sure client will get a different experience. This is a flexible flexi-cap AIF, so there is no market agnostic, no market, it's completely market agnostic, cap market agnostic, and open-ended. One can redeem anytime subject to 1 year of exit load, but there is no lock-in at all, and I think we are here to give a different experience altogether. Of course, we are closing this on 15th of December and 31st of December. And of course, this will be open thereafter every month for the investors for that matter.
Thank you so much, sir, and I wish you all the best and Team Pranitya as well. So now I think we can move ahead with our 65th market outlook. So the first question that I would like to ask you is, what do you feel about the current global situation?
Yeah, of course, global has become now very critical than the local. We have seen last couple of quarters, couple of months, global has taken a center stage. But fortunately for this time around, we see a bit calm on the global front. Barring couple of things which come to our mind, we can discuss that. The first thing is like Japan. So a lot has changed there in terms of their bond yields, the interest rates and the inflation. As all of you know, the 30-year bond has moved to about 3.5% in Japan. The inflation has gone from 0 to 3%. Of course, that is over a period of time. But all that is completely new and multi-decade change for Japan. For them to adjust to that situation is going to be a bit difficult. All that started with the US trade tariff. The inflation in followed of that has, inflation in Japan has went up, food and other inflation, and started making rounds, and eventually the situation has come. The Bank of Japan has to raise rates. That's the last option left to them. Japan as a country is the most indebted country. So they have, everybody knows we talk about US, but Japan has 230% debt to GDP ratio, which is the highest in the world. And Japan also is an exporter of capital to the globe. So there is, previously there was hardly any interest rates. So yen carry trade is very popular. So a lot of money goes out of Japan to earn money. So that is one threat we feel. Why we are talking about Japan? That entire yen carry trade is expected to be around 800 to 1.2 trillion dollars, 800 billion to 1.2 trillion dollars. And if that is to unwind, it will create some kind of a tremors. So major beneficiary of that, of course, India is one of them, but of course, US and Europe is also one of the major beneficiaries. Will that happen? Not happen? Nobody knows. If Bank of Japan is able to contain the things, you may not this kind of a situation and things can be a bit calm than what we are expecting. But this is one red flag. Second could come from the China. Like China is investment economy. It is not like consumption economy.
True.
So China has to invest in infrastructure, manufacturing and real estate.
Yes.
Once they stop investing, the GDP collapses. And this is the first month we've seen after long, the growth in investment has come down to 1.7%. And that is a bit alarming, and that means China may not grow the way they are growing till now. So one can see some kind of a shock from China, because China is again second largest economy which size-wise, which
True.
contributes to the world GDP, global GDP. So if global GDP falls, India will not remain too insulated, will also get hurt to the certain extent. So that shock can come from China. And third is US itself, like everybody knows about $36 trillion of debt in US. When we see about size of the debt and 124% to GDP, there are many countries have more than 100% debt to GDP ratio. Some European countries, Germany and so on. But all that is don't talk much about that for the very reason these economies itself are very small in nature, small size in nature. And secondly, the dollar, their currencies are not the global currencies. So people look at US differently than the GDP of rest of the countries. So it is expected that 10 years down the line, that the outstanding debt can go to $54 trillion and so on. And it's very difficult for US to now service that debt. I don't know and nobody knows how this impasse is going to end. But today the threat from US is that they are in debt trap. No fresh investment happening in dollar. Dollar eventually is going to depreciate, though we have seen it's rupee crossing 90, but I think that is more to do with the FI exodus, the FI have been taking out money from India, and that is a short-term phenomena, maybe lasting for few months, but in long run, everybody expect dollar to depreciate against the rest of the currencies just because they will not be able to service the debt which is expected. And reserve currency, people are preferring gold and silver at this stage than the dollar. So that is one thing one need to take care of. Rest, I think globally things are okay at this stage.
India has always been a consumption economy, and in fact, we would be very keen to know how do you read into the current Q2 results?
Yeah, Q2 result came actually as a surprise. Like according to Money Control, the top line growth was around 7 to 8%, and bottom line net profit growth was of whatever results have come till date is around 20 to 25%. That's a significantly high growth. If you break them into different sectors, barring FMCG because of that, I think GST adjustment where they have to push inventory and that's how they are facing pressure. But look at IT mild positively. We expected a big threat to IT because of US tariff. That has not come through. Real estate is growing. Auto has shown decent numbers. Rest of the industry like service industry, hotels and all showed significant growth. Pharma is outlier, completely phenomenal level. And most interesting was the banking and financial sector where when the interest rate fall, we expect them to have contraction in NIMs. And also the fear of job losses converting into delinquencies in terms of and increasing the NPAs. But interestingly, the picture was quite reverse of that. And though they come out with very good numbers, and that is how we could see market moving in post the Q2 result because expectation will we entered and market delivered. Of course, we have hit the new high, but still out of BSE 500 companies, even 70% of them are still below their 52-week low. And in terms of Nifty also, the significant number of companies, maybe 50%, has not even hit the 52-week high. The question comes then how Nifty and the index has topped. Of course, this Nifty rebalancing happened. New companies come in, old goes out, and this time around we have more of a new age companies entering Nifty with high PE and high market capitalization, and that is how we could see the new high before rest of the market hitting the previous 52-week high.
Right, sir. So, what are the factors that are actually helping the Indian economy as well as the equity markets? What are the positives that you see at this point of time?
See, there is always a question mark as to why India is growing and why India should enjoy premium the way they are enjoying. I think Indian GDP growth, if you see over the last 10 years or 15 years, is a completely linear line. They are growing steadily, barring of course 2020, which was a COVID year, but rest of the year we have been steadily growing. That steadiness of GDP gives more confidence. The earnings, we have now 500 companies having more than $1 billion of market cap. Market cap itself is 4 trillion. So India has come out as a significantly big market. And factors, if you see why we are positive and what can drive market, I think there is a big list. So starting from the revision in the GDP growth by many agencies, this quarter is I think 8.2 and
Yes.
overall 26 we can end up with even 7.8. All that is still not factored. We are not factoring so many things. In spite of US trade tariff, I think we got stellar Q2 numbers. Monsoon was good. The interest rates are coming down. Inflation is all time low. We may not get rate cut because it will not help because already we are doing well and inflation is down. But that can also, we have enough scope for cutting rate with the RBI. So that can help the economy. Generally, rural is now kicking in. The consumption is on the rise because government has gone and done the GST cut. All that is helping. Banking and financial sector, which is 30-35% of the Nifty, is in the pink of the health with borrowing costs going down. The only challenge what we see is the capitalization is not happening. So investment is not happening, though results were good and all that, and given the we expect it to be. If you see 2019, we are virtually doubled in terms of market cap now. Means company.
True, sir.
But if you see same time, investment number or investment has only gone up by 75%. So that is, we are lacking, the corporate balance sheet size is growing, but investments are not going in tandem. And on the other side, if you see the leverage, so we are balance sheet equity to debt was 0.58, which has now come down to 0.33. So that is deleveraging of thing happening. So there are many reasons, like people are resorting to internal accruals. Maybe the IPOs are replacing bank loans. So that's a big shift. So people are less borrowed. Corporates are less borrowed than they were 10 years ago. So that is very positive for any economy to grow. FIs will come back, not come back will be seen. I'll discuss that separately when we come on the FI topic.
Sure.
But today there are a lot of tailwinds than the headwinds. So we feel of course we are not a very cheap market anymore. There is no scope of re-rating. So all goes with how we deliver the returns. And usually market is nothing but in the long run, the earnings growth track the corporate performance. So if earning growth is better, I think we will have market moving up again.
Absolutely, sir. So as you rightly mentioned, rural economy has been silent for a very long time, but hopefully the uptake in rural economy will definitely help the Indian consumption story going ahead. So with all the positives, do you foresee any risk factors that will impact the India growth story?
Yeah, one is like the trade deal is still not there.
Yeah.
So market has factored 25% tariff. If you get 15 like other countries, it will be very positive. But the fact of the life deal is not there.
Yes.
There is a pressure on us to cut the oil from Russia. So might be, though oil will remain benign, so we don't expect oil prices to go up.
True, sir.
But that also is a bit negative can come, from the FIs still selling. I'll answer that question, but FIs are still selling.
Right.
The investment cycle is not picking up. Third negative could be a government ability to spend because government is doing the heavy lifting today. The entire investment is done by, but they had played a gamble by cutting the taxes by GST. If that doesn't pay off, then their ability to spend more will be affected. That's what we feel is a negative thing. And in general, we are too dependent. We don't have any. If the investment and next phase of investment goes for any artificial intelligence and high technology and all that, India will not be a recipient of that because I know out of this top 500 companies, none of the companies own any or the IP for that matter, IP.
Right, sir.
So will be not attracting this kind of a fresh new capital if that comes to us. And the global situation will remain challenging always. India has its own issues, so we may not agree to some certain terms with US because of political issues, vote bank and agree and all that. So we are in midst of all these things. So let's see how. But I can say there are more tailwinds than the headwinds. That's the situation today.
Right, sir. So fortunately, post 2020, India has seen a lot of domestic inflows. Today we see a total number of SIPs on a monthly basis almost to the tune of 25 to 30,000 crores. But a question that always strikes us as an investor is that why are FIIs selling or exiting from India at this point of time?
Okay. Initially, I think last year we underperformed global markets significantly.
Yeah.
I think we have virtually zero returns and emerging markets, Europe gave 30% plus. So there's a significant amount of underperformance after a really long time. it is never the case. I think last year started with couple of headwinds, including the US tariff. I think that was a major stumbling block. So we are too dependent on US for technology and services exports. So people thought India will get affected significantly with this kind of a decision. We are also trading at a very high valuation that point of
Yes.
time,
Yeah.
and nobody wanted to take the risk because if that was used to bring down our earnings and all that, it could have been a double whammy. So you have
Absolutely.
very high valuation and no growth type of a situation. Secondly, fresh investment, what has happened last year is gone to AI or the technology side. So India, we don't have any. So you see Taiwan, US,
Yeah.
all these companies attracted huge amount of capital expenditure, but we are not the recipient of that at all. And third factor could be rupee dollar kept appreciating against rupee. You see, we are already crossed 90, which is very deterrent for any investor who has come in at 85 rupees.
Yes.
And in a matter of 2-3 months, we already crossed 90.
90.
It's a good actually time for any FI to come in at this level, because long-term expectation on dollar is dollar to depreciate against all the currencies. So that's what we are hopeful. Slowly, FI will, and see the most other factor 6 months ago was sell India and buy China and Taiwan, because those markets were trading at 7 and 8 P.
Yes.
They were very cheap and growth was to come back there. They could see the growth coming back, and with the lower valuation, naturally it was an easy trade. And the last factor which I feel is US itself. Like, there are a lot of issues within US. US bond yield is already at 4.5%, 4% and all. So there is a natural tendency of people keeping money within USA or get back to the home country and not leverage and invest in this other part of the world. So flows into the global markets outside of US, which is a major mother country when it comes to attracting flows outside, itself, the volume itself was low.
True, sir.
So that made things a bit difficult for India to attract capital. But attractiveness of India doesn't die. I think with the Q2 results and the strong mandate which government got and all that, will make FI rethink. Anyway, it's a blessing in disguise. Their exposure to India is at 15, 17-year low.
Yes.
From 22% ownership, now they are down to 15% ownership. So that makes things easier. So they may not sell much from here. Abhi aur kya bechega?
Correct, sir. Correct.
So in a way, we will expect FIs to come back again. They have never been so underweight in terms of MSCI index. They are, I think, 20% underweight today. And for index fund, at least they have to come back because they can't remain so underweight for such a long time.
Absolutely.
So that's the situation. But it's anybody's guess when they will come back.
That's true, sir. So I know you have always been a true believer of asset allocation. I mean, working with you for almost more than 2 decades, and that is something which I've genuinely learned from you. So in fact, we would love to know about your views on gold and silver as an asset class.
Okay.
And how do you?
Of course, last year gold has virtually more than doubled. Silver has given 90% of the returns.
That's right.
All that came as a surprise, so nobody predicted. Otherwise, everybody allocated money to gold and silver than equity.
Yeah.
All that come at the hindsight because of some evolving situation. I think major again coming back to US. It's a global equation. When dollar is weak, the gold is up. So that trade played off well, because looking at Trump policies and what happened to Russian assets globally, they got confiscated by Americans. All that has not played well. So people are afraid of keeping any money in outside of their own country. So gold becomes a natural hedge, a natural option to buy.
Yeah.
So instead of putting more money into by central banks into the US treasuries, people prefer to keeping in other assets. So that made gold the only option, and silver has gone up along with gold because that is option number 2. Very difficult to collect and deposit, but there is a natural problem in terms of demand and supply at this stage. So the supply is much lesser than the demand because of EVs, data centers, and power and all that, which consumes a lot of silver physically. So there is a natural shortage of silver, which led to this silver rally. Now coming back to current situation, what will happen next 1 year? I still believe the equation with dollar remains the same and US remains the same till the Trump has a tough stand. So people may not invest too much in US treasuries going ahead. So naturally money will go into gold. Gold has recently gone a little bit down and all because Russia has sold some gold because for their funding their war. But otherwise, we feel we are more bullish on silver than gold. Gold will go up, silver also will go up significantly from here.
Right, sir.
And they will play a significant part of your asset allocation even next year also. After that, we'll need to see. But there is a visibility of good upside,
Right.
if not equal to what we earned last year. But
Absolutely.
there will be definitely upside. It may not be equity is to be seen like.
Now, sir, in continuation with asset allocation, what is your view on fixed income? Do you think investments in fixed income still makes a lot of sense considering the taxation benefit which has gone away?
Yeah. So see, we cannot ignore fixed income as an asset class. Best example was last year.
Yes.
So they have beaten equity by 8%, 9%
Absolutely.
varies, or 10%. So because yields also have come down and some bond funds have given more than 8-9% returns.
True.
Though because of global situation, the rates have not, yields have not come down as the rates have been cut. Almost central bank, India, RBI has cut 100 basis point. Global bankers are following easy money policy, looking at their problems. So all that will help even yields to even go down from here for next 1 year. So I think there is enough money to be made on debt, which is with
Right.
certainty. Nobody can beat the quality of debt. So you can't. It's a different asset class altogether. So allocation, as if you are a corporate investor or a large treasury and all, there is always a compulsion to allocate to debt.
Right, sir.
And even for a large family, any individual, you should have right balance of debt equity in your portfolio. Sometimes debt will do well, equity will remain flat. So idea is to generate optimal return with blending debt as asset class. You can blend with the hybrid assets or independently as a debt, which has become bit inefficient in terms of taxation. But as a hybrid asset, we will prefer debt even today in the year. Of course, RBI will cut another 25 basis point. We don't know tomorrow.
Absolutely.
But there is a scope for RBI to cut rates, and because inflation is too low, that allows them to cut further, and
Right.
growth is intact. So growth has not collapsed also. So debt becomes, only thing is like there will be crunch, a little bit of crunch of money. So corporates are doing a lot of capex. It's like capex cycle is going up little bit, and one need to see. But on the other hand, we've seen deposit to loan ratio is dropping significantly. It's gone down to 10%. It used to be 20-25%. Some because savings, India has now become a spending economy than a saving economy.
economy.
So
True, sir.
yeah, I don't see next generation going to bank and making deposits. So bank will have to really adjust to the reality, and interests are bound to go down, and people more money is channelizing into capital markets than debt. So debt as of now for next 1 year is definitely yes, and one can look at it.
Excellent, sir. So your advice for investors at this point of time?
Yeah, it's always challenging to give advice. This is my feeling, like what I can do. I can't advise,
Absolutely.
we are a distributor.
We are a distributor.
But generally speaking, I'll remain quite optimistic at this point of time. Why? There are a couple of reasons. So I think we have 14-15 months of bad phase which is over. Reality is that in long term, market always track the earnings growth.
Yes.
So it's a high time for us to improve in terms of our earnings. So last year earnings growth was very minuscule, but this time 25-26 it will be 8-9%, and 26-27 we are expecting to be 14-15%. So that will be achieved base effect, and we know the numbers, we know the capex. It is a mathematics end of the day. And looking at your GDP number and the inflation, it is very easy to calculate your with the nominal GDP growth number. Very easy to predict the corporate earnings. Secondly, with the government cutting taxes, GST rationalization, interest rate being lower, all that factors should play well in second half of the year. First half, I think monsoon extension was a bit of a cause of concern, and that is how we can see second H2 to be better than the H1.
True.
So, and the H1 numbers are far better than the expectation. So all that calculation will lead to positive bias for equity. So once we weigh risk reward in terms of equity for sure, and I feel slow allocation to equity from, we don't, as at least said, there is no way of any rewriting of markets.
Correct, sir.
But we are fairly priced market as of now with a certain amount of growth. The fact that a lot of stocks are yet to hit their 52-week high also leaves, if they do well in coming quarters, there is 20-25% upside for these stocks available.
Absolutely.
So we are little positive in terms of market. I may not allocate 100% at one go, There are not many big events to watch for. I think Fed cutting 25 basis point will lead to some kinds of positiveness. And you know, whenever there is a Fed rate cut, money flows into the emerging markets and other places.
Absolutely.
FI also, we are waiting for two things. One is a US trade deal happening, and second is FI turning buyers into a market.
True.
These are two triggers for India to, you know, propel into a completely new higher zone. And with a good amount of certainty, I can say next year can be 13-14% returns on equities visible.
Absolutely, sir. So one last question before we close for the market outlook for this month. A very interesting one is the rupee dollar movement. How do you foresee
I
this
think
going ahead?
I covered part of it
part
in
of
the
it initially,
discussion,
yes.
but in the short term, we have already gone to 19. India still holds $90 billion of reserves, but we have been judiciously using our reserves to defend the dollar. RER basis, like there is a method to calculate the real value of rupee, we are still undervalued. That value is 103 rupees. So there is a natural, if somebody allows rupee to depreciate, it can go to 103 also,
Right.
but that will not happen. Right. So we should remain somewhere here around 90s, and then eventually, if you ask 1 year down the line, I think we'll go back to 80, 85 again, because dollar is expected to depreciate against all the currencies. Today, I think because of FIX, huge amount of, they had drawn $1.25 billion from the system in a very short span. That has withdrawn in last 2 weeks.
Yeah.
So that has really created some kind of a pressure on rupee at this stage. Otherwise, and this is good for any IT companies and exporters in India, that offset some kind of a tariff issue. But this kind of move from 85 to 90 in a short span is not advisable or not good. I think we should remain fair. 2.5% depreciation is what one can expect, which has been the average for last 3-4 years.
Right, sir.
But in long run, it is expected that dollar will remain under pressure globally.
Right, sir. Right, sir. So thank you so much for your insights on the market. It was very critical to understand how the situation is going at this point of time, considering the global as well as domestic movement. We truly appreciate your time. Thank you so much, everyone.